All right, we're going to get started with part 2 of our intermediate governmental accounting. We're going to go over the fund financial statements in part 2. So we went over the governmental accounting principles and concepts. We got all that down. We're going to do fund, then we're going to do government-wide, and then we're going to do budgetary accounting, which is really, really easy. So we are going to get very technical, but it's fun. So it's a little late to say this, but this is a great time for you to pull out your audit report, pull it up online so you can follow along with Diane as we go through this stuff to see what we're talking about with your own. So fund financial statements, we have a balance sheet, and then it is called the statement of revenues, expenditures, and changes in fund balances. That's the technical name. That is a mouthful, so I will call that, I will use the generic term called an income statement, right? So that's revenues, expenses. That's where that one is. Then there are some funds have a statement of cash flows. You need to stay tuned to know which ones have those. And then we're going to talk about fund balance categories, and we are going to talk about major funds, and we are going to dispel the mystery because you will be able to determine which of your funds are major funds. All right, so we have our 3 categories of funds: governmental, proprietary, fiduciary. Under governmental fund, we have 5 types. We have our general fund, our special revenue fund, our capital projects, our debt service, and our permanent funds. Under our proprietary, we have 2. We have our enterprise funds and our internal service funds. We have a for-profit motive. This is economic resources and full accrual basis of accounting. And then we have our fiduciary funds. We have our 3 different kinds of trusts. And then should it be other people's money that's not in a trust, we call that custodial funds. All right, so here is your cheat sheet on financial statements for all of that stuff. So what you have for governmental funds, the measurement focus is current financial resources. We do the modified accrual, and the financial statements speak to those 2 things. Okay, so here for governmental funds, we just have the balance sheet and the statement of revenues, expenditures, and changes in fund balances. Then when we get to proprietary funds and fiduciary funds, they both are economic resources and accrual basis of accounting. So let's take them one at a time. Proprietary funds, it is called a statement of net position. It's not called a balance sheet. I may use the word balance sheet because that's the generic term for assets, liabilities, and equity. Okay, but it is called a statement of net position. And then there is the statement of revenues, expenses, not expenditures, and changes in net position, in fund net position. Different from net position because that is government-wide. So we have fund in front of that. And then those little puppies also have a statement of cash flows. Why? Because they're the ones that are the most like the for-profit world, right? For-profit has 3 statements of cash flow. If we had time, I'll tell you the Woolworth story, but we don't have time. But to summarize, Woolworth went into bankruptcy, and had there been a statement of cash flows, they would have seen it coming. They didn't see it coming, so then after that is how we got the statement of cash flows for that. And then fiduciary funds, they are also economic resources and accrual, and they just have 2. This is other people's money. Not so concerned with that. So we have the statement of fiduciary net position, not fund net position. And then we have the statement of changes in fiduciary net position. We don't have a statement of cash flows because we don't really care because it's not our money. All right, so let's take a look at the balance sheet. Here's the equation. This is where all is right in the world for accountants. This is what we love, right? So we have our assets, and we have our plus deferred outflows, and we total those together. And then we have our liabilities, plus deferred inflows, plus our fund balances, and we total those together. Those 2 totals need to equal each other. Everything is in harmony, okay? Spoiler alert, on the income statement, you also calculate fund balance. So the fund balance on your income statement needs to be the fund balance on your balance sheet. That's kind of how it goes. When that's out of whack, even by $1, we lose sleep, right? And we fix it, and we get it right. And that's how we know we got something wrong, when those 2 are not in balance. So there we go. So let's take a look. This is when we get to tour around our beautiful state in Louisiana. So we're going to start with the capital city in Baton Rouge, city parish. So this is their balance sheet for their governmental funds, because that's what we're going to start with first, our governmental funds. So you can see that they have, for this page, there are 3 major funds that they've listed. And then you can go down and look. There are their total assets. The next slide has their liabilities. What I love about the city parish of Baton Rouge, because I like to read financial statements, is that right there they put the note. So if I want to learn more about cash and cash equivalents, I know right now go to note 3. And so I can go back to note 3, and then I can come forward and go to the next one on their property taxes. So what you see here, it's also in order of liquidity. Cash, by definition, is the most liquid. The other things, as you go down, right, take longer to turn into cash. That's what we mean by order of liquidity. What's missing here? Ain't no capital assets here because we're on the current resources. Okay, no capital assets here. So that's theirs. And then here's to make it readable, I had to divide these things up, but they're usually on one page. There's their liabilities. They do have some deferred inflows on their fund financial statements. We do see that, that are related to, look at that, unavailable revenue. What do you think that means? Wasn't collectible in that 60 to 90 days. Is that not cool? You see, like what you learned in the first part, you're like, dude, that's where I put it. This is so cool. Everything comes together. I love it for that. And then they have their fund balances, which are explained in note 15. And in their different funds, they have different categories of fund balance. So, and then you see the total, the $204 million at the very bottom in the general fund column is the same as the total assets. Okay, that's our balance sheet equation. All right, we got this. You see, this is not hard. We just have to work together and share our knowledge. We got this. So let's talk about those categories of fund balance. There are 5 categories. This is courtesy of GASB 54. There are 5 categories. Non-spendable means non-spendable in form. That's our prepaids and our inventory. Remember, we talked about liquidity. These guys take a little longer to become liquid. So when we talk about our equity, right, assets plus deferred inflows, liabilities minus deferred outflows, equity that we have, we're talking about some of it we can't spend just because it's not spendable in form. And then we have 3 categories of restrictions. These are based on who is restricting from the most restrictive to the least restrictive. So restricted means legally restricted by external parties. So this is going to be, you will see this in your debt service funds. Okay? So you will see that they are restricted by the bond covenant to only be spent on debt service. External parties. You will see these with grants, grantors in your special revenue funds. These are restricted by an external party, not by the CFO, not by the governing council. Okay? Then we go to committed. Committed is by your governing council at their highest level of authority. Okay? So that's going to be by ordinance or resolution, their highest level of authority. And then it's going to be assigned. Assigned means I have an idea. I think we ought to save some money and build a new town hall. Okay, well, let's do that. What do you want to do? Let's put $100,000 a year and build up our fund balance, and then pretty soon we'll have enough and we'll be able to build our town hall. We won't have to issue debt. Everybody will be happy. That's a great idea. No ordinance, no resolution. We have a motion, we have a second. Why is this important? This is important because people need to know how to undo it and how quickly it can be undone. Okay, so they need to know who's restricting to what degree and how quickly can it be undone for that. So these are the strings attached, and then everything else is unassigned in our fund balance. That's like none of the above. That's everything that filters to the bottom. So let's take a look at the city of Denham Springs in their fund balance section. They have non-spendable, and look, they have permanent funds. So they separated out. Remember, we talked about permanent funds. Can't spend it. One of those can't have your money accounts. There you go. They separated that out. Then they have their restrictions on the face of their financial statements. They say it's restricted for witness fees and other purposes. Restricted, legally restricted by external parties, by law, right? There we go there. And then they do not have any committed. They have assigned. So they have assigned to capital projects. That's probably that idea of let's set aside some money to build our little town hall or whatever it is. We've assigned to capital projects, and then they have their unassigned and their different ones. Okay, so you don't have to. You could see in Baton Rouge, they just put non-spendable, restricted, committed, but Denham Springs said, no, we're going to put on the face of the financial statement what it's for. So if it's not on, this is called the face of the financial statement, then it's going to be in the notes, what it's restricted for. Is that not cool? Is that not cool? So now you know, like it tells the reader like what's going on with your equity. Now let's talk about major and non-major funds, because we saw that in, we're going to see that in our financial statements going forward. So major funds, I mean, as the name implies, it's the biggest funds. They're the most important. They get their own column. They're so important. They are, when your auditor opines and expresses an opinion on your financial statement, he opines on major funds. So sometimes you might get a modified opinion that carves out a major fund. And you might get clean opinions on other funds, and you might have a fund that's carved out. The general fund is always a major fund, always listed first. How about that? Internal service funds can't be classified as a major fund. Only governmental and enterprise funds. You know what? I forgot this little point of trivia until I was working on this. So I'm like, dude, that's really something. So you see those fiduciary funds? No matter how much money you have in those, they're not major funds. Only your governmental funds and your enterprise funds can be major. They do change from year to year. Why? Why do they change? Drives me nuts. That's my husband's phrase. Drives me nuts. Well, because it's relative, and it's based on their size, and it's two kinds of factors. But you guys are so good, and you know your funds so well, that I'm going to show you how to calculate that for you. And then non-major funds are the smaller ones, okay? So you can understand financial statements, tons of numbers. Look, Baton Rouge was in the hundreds of millions of dollars, right? So the non-major ones kind of get lumped together, don't make a big difference in the scheme of things for that. And they are aggregated by fund type in one column, but further back in the financial statements, in the supplementary information section, you will see the individual funds for that. Okay, so they are not in the front on our basic financial statements, they're in the back in our supplementary. So here we go with Claiborne Parish School Board. So what do we have here? We have a general fund, we have a maintenance fund, we have an education stabilization fund, and everything else. Those are our three major funds. General fund is always major. And then we have our non-major governmental fund. And you see that $2 million right there? That's statement C. Go to the back. And here is where they aggregate it by fund type. So of all those non-major funds, we still don't know how many. We have special revenue funds. The non-major special revenue total $2 million. We have the little debt service and the little capital projects. Can you see how the debt service and the capital projects are really kind of small? You know, don't need a lot of attention, not a lot of focus for that. Let me see where I'm going. And then special revenue funds, $2 million. Okay, let's take a look. What we have here is this is the second page of their special revenue funds to total, because they had a ton of these, and there it is. By each individual fund they're showing in their special revenue fund. Is that not cool? This is what we call transparency. Okay, this is all the activity in all of our funds. All of your funds are your babies. You need to take care of your babies. You need to make sure they balance and the right things get recorded in those funds. Don't forget about them. Don't forget about early childhood with that $314. You got to take care of that. What else I wanted to show you, I'll show you here, is a question of, Diane, What kind of fund is the main? No, we're going to have that discussion somewhere else. I remember now. We're going to talk about that. Here's your calculation on your major funds. How do I calculate it, Diane? How do I calculate it? So we got a 10% rule and we have a 5% rule. You have to pass both. First, you do your 10% rule. Okay? So those are the elements along the left. And you have 4 choices right there. You have your assets plus deferred outflows. You have your liabilities plus deferred inflows. 2 big numbers on your balance sheet. And then you have your revenues, expenditures. Okay? So first, your 10% rule. Is the fund in those elements greater than or equal to 10% of the total in all your governmental funds? Remember, only governmental funds and enterprise funds can be major funds. That's why we're doing it this way. So first off, is it 10% or more of your major? So you go and you have to estimate it in the beginning when you do this. So I used to just estimate this, and if it was on the brink, I'd figure out what to do. I'd make a decision one way or another, right? So I'm going to go calculate that. Then if that answer is no, dude, you're done. You're done here. Okay, so some funds are going to fall out right there. You're relegated to the non-major column. But other funds are going to keep going. Yeah, they passed that test. Okay, let's do the 5% test. Now I have to go say those elements, are they greater than or equal to governmental funds plus enterprise funds? And this is 5%. Okay, so it's got to be the same element. So if you have assets and deferred outflows are yes for one and no for another, but expenditures have a yes where the other one has a no, it don't work. It's got to be for the same element, okay? So now you know, no mystery, no secret. It's not just that for the purview of our auditors. These are our financial statements. The auditing standards say the financial statements are management's, and the auditor's responsibility is to express an opinion on them. So there's major funds. So that is the quantitative. Okay, so let's say you have a fund with a no that doesn't meet that. However, the second caveat that GAAP allows us is that if the fund is particularly important to users because of public interest or consistency either way. So then when you think of those things, American Rescue Plan Act fund, this has been very visible. Everybody knows, municipalities, it was, manna from heaven. All of a sudden, give the Treasury, your U.S. Treasury, your bank account, and boom, you have money in your bank account. You're good to go. You've got this money kind of thing. But your public wants to know, what are you doing to spend it? We keep hearing about this in the paper. What are you doing to spend it? Okay, so it may not be major, but it's high public interest. Also, for those who go through natural disasters, FEMA is a lot of money. It can start out being a major fund, and then it may peter out. But because you might want to keep showing that one as a major fund. So management can decide, I like this guy as a major fund. I'm going to keep showing him as a major fund. Okay, so you have that option. Quantitative and qualitative factors. See, the mystery is solved. We got this. We got this. All right, let's go look through the income statement of a governmental balance sheet. Statement of revenues, expenditures, and changes in fund balances. So here's the equation. We take our revenues, we back out our expenditures, and we get our excess right there. But then we have to add in those things called other financing sources and uses, plus or minus, right? Whatever they net to. And those were those things like we talked about before, like our debt service payments, our financing agreements, and our bond proceeds are in that section, right? The principal and interest payments are in that section. So we're going to add those things back. And then right now, subject to change is special. We do special and extraordinary. These are usually expenditures. We don't have time to talk about these, but these are just unusual events that happen that are infrequent in occurrence. In Louisiana, it's not a hurricane because, they're frequent. So it's unusual events that happen that are major costs. And then we get to our fund balance. We get to our net change in fund balance. That's your bottom line. Okay? And then you're going to add your beginning fund balance to get to your ending fund balance. This is on your income statement. So this ending fund balance here has to equal the ending fund balance on your balance sheet. Same number. Same number. If it doesn't, you have to go back and keep working. You're not done, you can't go home. I don't care if it's 9:30 at night. Got to keep working to get that. So let's take a look at St. Gabriel here. For St. Gabriel, here are their revenues. So you do revenues by your major source of revenue. So here we have general fund. They're going by fund type. They have a capital projects fund and a debt service fund. They call it that. But they are major funds. That's just the title they gave to their funds, because then you can see the non-major, and they only have one. I picked a small one on purpose for this, and that's a non-major, and they're telling you it's a special revenue fund. So it looks like they got a grant. So we can see their revenues all separated out, and then we have their expenditures. So what they're doing, this is a city. These go by major function. So they have their general government, and public safety, streets and sanitation. This is common in municipalities. And then they have, see their debt service? That's where they have that for their total expenditures. So their debt service paid out of the general fund, they put up there under their, where their expenditures are. So they come to their total expenditures, and then they have that first excess, that first subtotal, right? Then they're adding in their other financing sources and uses. A lot of us have those transfers in. That's where we do all those transfers with other funds. So you can see that two funds got money in to the tune of $4.5 million, but you can also see the transfer out from the general fund to the two funds in the same amount. That's good. Everything balances. We like that. Actually, we're off by $500,000. I know what that is. That's transferred to another fund type. That's not a governmental fund for that. All right, and then we get that change in fund balance. So for them, they're looking good, right? It's all positive. Add their beginning fund balance to get to their ending. So you see, not that hard, right? We can see this for that. Let's take a look at Claiborne. Here's where I wanted to come back to my friends at Claiborne School Board. Because for St. Gabriel, they told you the fund type. But the Claiborne in telling us, so what fund type is a maintenance fund and an education stabilization? We don't know. We don't know. So there are hints, okay? There are hints to these. The first hint is where they're placed, because we tend to go in order. Special revenue, capital projects, debt service, okay? That's where we go. And then we look at the kind of income that they have, because that also can be indicative of what they have. So the maintenance fund gets ad valorem taxes and for that, and then they have a couple of other things. So when we think of the word maintenance, for me, ad valorem tax tells me there is probably a tax that's dedicated to maintenance for the Claiborne Parish School Board, not capital outlay. Maintenance is different from capital outlay. So I'm thinking this is a special revenue fund. Okay, and it can be borne out by when we see what the expenditures are. The education stabilization, there they go under state sources, federal sources. They have $3.2 million in that. You know what that is? It's a federal grant. Okay, so where does that go? Special revenue fund. So you see, even if you can't tell by the title, when you take a little bit deeper dive, you can tell by what's going on the line items. I mean, this is so cool. This is so cool. All right. Do we have any questions before we move on to proprietary fund financial statements on governmental fund financial statements? Y'all got this?
I have one.
Let's go to her first.
The online people need to hear your wonderful question, Karen.
It's okay, I need the exercise.
For the debt service, principal and interest payments that were on the general fund, what would be a circumstance that would allow that?
When it's funded by the categories at the top, like they're just when it's the general revenues of the general fund and not a specific revenue source, it can go up there. Yeah, so if it's all funds available, so it's going to be your sales tax, your ad valorem tax, your fines and fees, you know, user charges, things like that, then you can put it there for debt service, yeah.
Is there a limit to the number of funds you can have?
There is no limit to the number of funds you can have. However, please take care of your mental health. Okay, it's important to us. So you do not need this is the argument about special revenue funds. You do not need a ton of them, okay? You just need to figure out a way in your accounting system to have that. And you also don't want to I always followed the keep it simple rule. Just keep it simple. You know, I budgeted according to GAAP basis so that I didn't have to convert from my budgetary basis to GAAP. I mean, everything we did was just GAAP. I didn't have time for all of these other things in my government or the resources to do those. So you want the minimum amount of funds that show the legal compliance, and you don't want to drive yourself nuts with that. So, you know, and then also your auditor. Now, I'll tell you what will drive you nuts, because I've been there, done that before, when we saw it in a government where they lump all their grants into one grant fund. Now when you need to break out grant 1 from grant 2 from grant 3, you may have issues. However, for the real astute ones who got to design their own chart of accounts, they may have like a GL code, and then they have like a sub-object code that may be a certain grant number that you assign to that grant. So that when I'm spending salaries on grant 1, it may end in a 123. And when I'm sending salaries on grant 2, it may end in a 456. And then I can run a report on that sub-object code to be able to account for all of that in a grant. So it's the amount that you need in your organization, the minimum amount to get it done. Too few, like City of New York, I can't imagine that. That would drive me nuts. I would lose sleep. I can't handle that. But, you know, no special revenue funds. But, you know, did Ascension School Board need 4 debt service funds? Maybe not. Maybe they could have put it all into one, you know, but they just like showing it 4 different ways. Well, they know that their creditors like showing it 4 different ways. So a lot of that is based on the resources that you have in your government, the size of your accounting staff, and the wonderful capabilities of your accounting software. We good? Any other questions? You guys have this. I'm so proud of you. I'm so proud of you. All right. Where? Okay, here we go. Proprietary fund financial statements. Okay, remember, these are our babies that are our business for-profit motive. We have 3 financial statements, and the internal service funds they have that cost recovery at least, and they serve their internal customers. So we remember that that's accrual basis, and that's their economic resources, and we remember that that includes long-term assets and long-term liabilities. So when we're looking at these financial statements, they're going to look a little bit different. So the balance sheet format is the same. It's the same equation. There on these, the GASB realizes there are old dogs, and so sometimes we don't like to learn new tricks, so they give us 2 equations on how we can present our balance sheet. It doesn't have to necessarily be the balance sheet format is those 2 totals that we saw that balance, but the net position format is your assets plus deferred outflows less your liabilities plus your deferred inflows equals your net position. So that's the net position format. That's what's preferred by GASB, hence the name, statement of net position. But for the old ones, until we all retire, you know, then some will choose to do the balance sheet format. So we get 2 choices for those. So here we go in the city of Kenner. Now, business type activities, kind of as the name implies, right? Our enterprise funds. This is important in part 3 when we talk about government-wide financial statements. We're going to see that a whole lot. So here's what we see for for Kenner, they've got 2 enterprise funds for their wastewater and their civic center. Remember we talked about civic centers? Sometimes it's in a special revenue, might be in a general fund. Depends on your motive. What are you doing with your civic center? They want to turn a profit on the thing. So they've got it in an enterprise fund. And then we have their internal service funds all up together in one column. So what do we see here? We still see that order of liquidity, right? It starts with cash and all of those kind of things. But, and then they have, so we're going down and we see our restricted cash, and we know what that is. When utility customers give us deposits, then we have to hold that, can't spend that, it's restricted, and then we have to refund the deposit when they move and stuff like that. So there you go for that. But they also have non-current. So the format on this, on a statement of net position, is current and non-current. Why? Economic resources, measurement focus, right? This is just so cool. It keeps coming back. You see how it all kind of comes together and helps us to understand? So here they are with their non-current assets, which are long-term assets, and they separate theirs out by category, less their accumulated depreciation. So then they get to their total assets. You see that? So they have to separate theirs out into current assets, non-current assets to get to total assets. All right, easy peasy. We did not have non-current assets on our governmental fund balance sheets.
What is a restricted equity in pooled cash account?
Oh, wonderful question. I love it. So sometimes in governments, they put all the money into one bank account and then they allocate it to the funds. That's what they're doing here. So that's what that is. So it's not called cash in your enterprise fund. It's called, oh, and they don't have, here, they probably have it in their governmental funds where they put the equity. So when you don't have a bank account in your fund's name, right, then you're like, you may have a bank account for utility funds where you make your utility deposits. You have a bank account for your general fund where you put your general fund deposits, right? Okay, so when you don't do that, you pool them together and then you allocate it. And so it's not called cash, it's called equity. So that fund has equity in the cash, but they don't actually have a cash balance in their name. Can I just tell you, it complicates things. So should you want the keep it simple thing, it's like, dude, open another bank account for me. Let's get this, you know, because it's also to the souls who are listening and the souls in the room who reconcile the bank statements, God bless you. Because when this one doesn't balance, you're like, okay, because you're going to go pull your general ledger and you're going to try to find it. And it's very, very hard to find when you have equity in pooled cash. So should you not have the time to do that, you're just going to separate it all out. Keep it simple. Yeah. Yeah, good question. All right. Let's look at the liability section for the city of Kenner. So here again, we have current and non-current liabilities, right? These are our proprietary funds. These are our for-profit motive funds. So we have to show everything, even our non-current. So under the wastewater operations, they've got $29 million in bonds. Those bonds may not be payable, you know, they may pay a little bit at a time over 20 years, but they've got the whole $29 million showing. On a governmental fund balance sheet, they're only going to have the amount that's due within the next year, and they won't have the whole $29 million showing. That's the difference right there for that. And again, liabilities are also generally issued in the order of how fast they're going to come out. The other thing to look at your bonds payable, because you see at the top, the last one under current liabilities, Diane, is that two separate bonds, 2.8 and then 29 million? No. They have to separate out the current portion that's due within a year. So the total, which is going to be disclosed in a note, is going to be the total of those two. All right? Easy. We got this. We got this. We now follow. And then they have their deferred inflows of resources under their civic center, which is probably has something to do with unearned revenue, if I were to guess, which I ought not guess. Okay. And then there's the net position section. So in the city of Kenner, here we are again. Okay, net position. What we saw on the balance sheet for the governmental funds, we saw 5 categories of fund balance. So Diane, this ain't 5 categories, this is 3 categories. Yep, you're absolutely right. First is net investment in capital assets, which is an advanced governmental topic of how to calculate that, but it's basically what it says. Of all the capital assets that you have, how much is not leveraged with debt? Do you own outright? Very complicated formula to get there, but that's basically what that is. Then there is contributed capital, and then they have net investment in capital assets. What does that mean? Very similar to non-spendable. I can't spend it because it's tied up in my assets. It's my capital assets. And then we have contributed capital, which is a category for all of those general kind of payments that you see there. They've broken theirs out. And then we have the restrictions and the unrestricted. So basically 4 categories, right? 4 categories here that we have. So net position and what makes up net position, all divvied up here. Contributed capital means that for their enterprise funds, they're getting in these kinds of revenues for it to help pay. So it's not just those user fees. It's also getting subsidized by taxes. All right, we're good to go. Let's go on to our income statement for proprietary funds. So this is what we learned in school. And this is your equation. It's called the statement of revenues expenses and change in net position, not change in fund balances, okay? And so what we do is we take our revenues minus expenses, we get subtotal number 1. Hang in there with me, we got a lot of subtotals on this one. Okay, we get subtotal number 1, it's called our operating. Then we're gonna add in our non-operating, whatever it comes to. Is it gonna be net revenues, net expenses? And then we're gonna have the wonderful title of net income before. Operating transfers, and then we're going to show our transfers, and then we're going to have before our operating transfers and those capital contributions before we get to our very bottom line here. So what does this show the reader when it's on one page? How, like that first one, operating income, how are we doing with our profit motive? And then what else is happening in these funds to help them get ahead if they're losing money, if that's not enough for them, okay? And so then we get to that change in net position, we add beginning to get ending. As with the other one, the ending net position on your income statement of net position here, revenues, expenses, needs to be the same as the total of your net position on your balance sheet. All right, so let's take a look at Lake Charles. Here we go. They've got a civic center and an enterprise fund too, just like Kenner, okay? And so here's their income statement for that. So you see their operating revenues, they have charges for service, and then they have other to get to their total. And then they have their operating expenses. What are we seeing here? We're not seeing by function, we're seeing by object. Salaries, materials and supplies. We're not seeing things like capital outlay like we saw on the in the fund financial statements, right? See? This is so cool. This is just so cool. All right, so then we come to our operating income or loss. Both the Civic Center and the golf course are losing money at this point. Okay, so now let's add in our non-operating stuff. How are we gonna help them out? So we get some grants to operate those. We have some interest income, and then the golf course, you know, Lake Charles, hard hit by Hurricanes Laura and Delta, and I mean, the hits just kept coming over there in Calcasieu Parish for our buddies. And so they had to, some of their assets that they wrote off their books, they actually showed a gain there, or the transfer. So now we're at our second subtotal, and what do we still have? We have a loss in the Civic Center, but our golf course is positive. But is our golf course sustainable positive? I don't know, because they had that one time on the gain or loss on the capital assets, right? Or the impairment. I don't know. Got to dig deeper. But at least it's positive. And then we add in that second category of our capital contributions for that and our transfers in and out. And now, change in net position down at the bottom, 7.5 million in our Civic Center. So our Civic Center's doing fine once it gets a little help in there. Okay? And they're both positive. So that's how to read that. So you see those three subtotals tell us things about the operations. When we compare this Civic Center to Kenner, you know, to the Civic Center that was a major fund in a special revenue fund. It's all we can now take a look. Y'all are going to just be so good at reading financial statements and understanding your own. There is a wealth of information in your audit report. So cool. So proprietary financial funds have a third statement. They're the only ones that have the statement of cash flows because of that for-profit motive. This is a statement that shows, this answers the question, dude, what happened to the money? Where'd the money go? Where'd the cash go? So what they have a little bit different from our for-profit statement of cash flows. So let's take a look at this slide. They have cash flows from operating activities. Yeah, we got that on the for-profit slide. They have cash flows from financing. So the way I learned it in school, operating, financing, investing. That's correct. But in government, you break out financing into capital and non-capital. So that's a nuance to governmental that you don't have in the for-profit world on your statement of cash flows. We're going to take a look at this, and we got this. We got this, okay? So there's non-capital financing, and that's related to those kinds of things like grant, taxes, transfers. And then we have capital and related financing. This is your capital asset stuff, okay? And then we go to investing. So let's take a look when we have to do this. So we start with a beginning cash balance last year. Our ending cash balance last year is our beginning this year. We add all of this stuff and we reconcile and we get to our cash balance in the current year. So let's take a look. Who is this? This is still Lake Charles with their Civic Center, right? Yeah, here we go. So here's their cash flows, net cash provided by operating activities, the 1.3 million. This is going to get reconciled. Keep your eye on that number because I'm going to show you what the other reconciliation that happens. And then they have their non-capital. You see where they get their operating subsidies from and their shared revenue? That was under the other category on the income statement, that 1.5 million. And then we go to their financing activities that they had for their various activities, and then we go to investing, okay? So you can see what they're doing here and what's going on and how they're funding their Civic Center and how the cash flows. So you see the $1.3 million on your statement of cash flows, you also have to reconcile the loss. So you reconcile the cash balance, you also reconcile on the income statement side, the loss from operating activities. See that 1.3? Okay, so where did we see that? Oh, they don't have it spread out here. I'm not seeing my 1.3. Because it's right here. Right, because it's the reconciliation. So these are all the things that don't affect cash because this is statement of cash flows. So you see how depreciation and things like that don't affect cash, adding those back in. See at the top, the net operating income of 3.2 million, that's the number to show you. The 3.2 million at the top deficit, that's right there in the middle. Operating income loss, 3.2 million. So that's what we're reconciling. That 3.2 million loss to this $1.3 million on the cash flow side. Okay, why? This is cash flows. Think cash basis, right? But just cash flows, and your income statement is your accrual basis of accounting. Okay, different, because it's not tied to when you get or receive cash. That's why you have it this way. So the statement of cash flows will answer the question, what happened to the money? Where'd the money go? What are the changes in that? All right, proprietary funds. We have any questions? I don't expect too many on that because this is kind of like what we learned in school, not that hard. Very common. So let's talk about our fiduciary fund financial statements. So our fiduciary funds, this is other people's money that we're holding, okay? So it's not really available to use in operations for our governments. So we're not so much interested in judging by things like how much operating income or loss did you have? How are you subsidized by taxes or grants? Because this is not how these funds work, right? This is other people's. So they do have a statement of fiduciary. Net position is the balance sheet statement. That's what it's called. And it's that same balance sheet. It's that equation that you only get the net position. You do not have a choice to do the balance sheet equation. You have to, for fiduciary funds, do it this way. Proprietary funds, you have the choice. You don't have the choice. For these guys, you have to do net position. So that's asset plus deferred outflows minus liabilities plus deferred inflows equals our net position. Okay, so here we go in the city of Shreveport. They've got a retirement fund. So, and there again, they've got their, now for a retirement fund, think about it. They don't have capital assets. So it's not so much current and non-current. So they've got their assets and their other assets, okay? You're not going to see in trust funds and things like that, you're not going to see capital assets. So this is for a retirement fund. Look, the vast majority are those investments. That's to be expected, right, in that kind of fund. So we have their total assets in order of liquidity, and then we have their liabilities that they have to get to their net position. Their net position is restricted. Remember, we talked about those categories of net position. So theirs is all restricted for pensions. Nothing else can't be used. And then the income statement side, it's the standard. For this one, actually, this is kind of new, implemented a couple years ago, GASB Statement 84. And so we have to do additions by source. We didn't used to have to do it this way. Then we have to do deductions by type to get to our change. And then we're going to, in net position, and then we're going to add the beginning to get to the ending. Y'all got this now. You've seen this plenty times in our income statements, right? But here it's called additions and deductions. It's not called revenues and expenses because they're not all revenues and expenses. Can't call all additions revenues and all deductions expenses. So here we go with their on their income statement side. So look at what their additions are. It's by contributions in their retirement fund, right? And they break it out by employer and the plan members. And then that, bless their hearts, on their investment earnings, they lost $32 million. That's a rough year. I thought I lost value. Whoa, that's hard. That's going to be hard to overcome and take years to overcome in 2022. That's a rough thing for them. And then a caveat for these is you have to net your investment expenses with you have to show your investment expense with your investment earnings, okay? Because we know that it costs money. They want to know how much money did it cost in a good year to earn money, right? So they spent they had expenses of $1.1 million. So that's to pay the professionals to manage their fund and manage their investments and invest their funds. That's basically what that is for that. And then it's called deductions, okay? It's not called expenses or expenditures. It's called deductions. And they have the benefits paid out. I would expect that to be the largest one in a retirement fund. And a couple of other things there. Their admin. A lot of people like to see those admin expenses because they want to know how much is being charged for this retirement fund, because you don't want excessive admin expenses for that. Okay, and so then it gets to their total deductions, change in net position. So this one, we have no judgment. It's not revenues, it's not expenditures, it's additions, deductions, and net change. That's all it is on fiduciary financial statements. So you good? All right, that's it. Oh, that one was too fast. Okay, let's see what we want to do. Somebody tell me about time. Well, we have another hour, right? We're going to, yeah, let's take a break. Let's take a 10-minute break. And then we do government-wide. We're going to spend a little more time there because it's more fun.